Welcome to the podcast about investing in startups, where existing investors can learn how to get the best deal possible. And those that have never before invested in startups can learn the keys to success from the venture experts. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back for another edition of Investor Stories. On this special segment, the experts describe the most important lesson that they've learned and how that has changed the way they invest. This is the special segment called Lessons Learned. On today's special segment, we have Scott Dorsey of High Alpha. Scott, can you tell us a story highlighting a critical lesson that has changed the way you invest?
Boy, there's so many lessons that are being learned continually. I think,
or maybe a lesson that had big effect on what you did at Exact Target. Could be on the investment side. Could be the way you think about startups and growth.
Yeah, no, I think I'll take it more down the investing side. So I think in learning how to be a great investor and really learning how to run the venture side of High Alpha, we are putting a lot of energy into how do we evaluate opportunities, how do we evaluate entrepreneurial teams, how do we make decisions quickly, and how do we treat the entrepreneur in a first-class way. And I think that comes from the culture we're building at High Alpha and also our background as entrepreneurs and operators. It's really, really difficult to raise capital, and it can be very time-consuming and very distracting and also difficult, to get a lot of no's along the way and ultimately find the yes. So I'd say where we're trying to incorporate our learnings are in being the best partner we can, not only to the entrepreneurs we invest in, but also those that aren't a fit for us. How do we treat them with amazing respect throughout the process? How do we be quick and transparent in our decision-making? And how do we still find value? How do we still find ways to deliver value to those entrepreneurs and build those relationships over time? So that's a work in progress for us, but that's been an area we've been spending a lot of time thinking about and refining and trying to be the best that we can be.
On today's special segment, we have Jeff Clavier of Uncorked Capital. Jeff, can you tell us a story highlighting a critical lesson that has changed the way you invest?
I think, every new investment decision and every sort of way a startup sort of evolves will inform the way you invest. But I think my Twilio story is one that taught me a lot in terms of trying to go for the optimal valuation, but investing at an acceptable valuation. So back in 2008 or 9, Twilio was doing a seed round, really liked what they were doing. Huge fan of Jeff Lawson, the CEO. And, they were raising a seed round at 5 million pre. And that was a lot of money for 2008, like 5 million pre. And I was like, well, I'm super interested, but this is too expensive. I'll invest at 3 million pre. And Jeff sort of came back and, negotiated a bit or whatever and said, hey, how's 3.5? And I said, I would have done 3 million. I would have invested at 3, but this is too expensive. And literally, I was right to be disciplined, but I was absolutely stupid to pass on just such an opportunity. And so this notion of, hey, the right price for this startup is X, but I'll go up to Y because I know that the market dynamics are such that it is what it is. And, I have friends of mine who are saying, I will invest at valuation X or I won't. And I respect them because they stay true to that, because I don't. I had the case, recently where we closed an investment in the company. I think actually we closed today, investment in a company where my offer on a post basis had to become my offer on a pre basis just because of market pressure. But I'm super excited. And at the end of the day, given that I have a larger fund, whether I invest $900K for 10% or 1.2 million for 10% doesn't really matter in the grand scheme of things. And so this painful lesson on being thoughtful but not stupid on valuations has been useful.
On today's special segment, we have John Fein of Firebrand Ventures. John, can you tell us a story highlighting a critical lesson that's changed the way you invest?
Yeah, I think there were a few lessons I learned at Techstars. where I didn't get to know the team members well enough before we made them an offer. And in some cases it worked out fine. In other cases it was a disaster. And so, I just learned that there's no substitute for investing the time. It's not something you can take a shortcut on. You have to invest the time to really get to know the founders beyond the pitch and just get to know, what their motivations are, why are they in it, their background, how do they work, how do they interact with other people. And you really don't learn that without spending hours and hours and hours with them. And so I think that was probably one of the biggest lessons I learned early on.
How do you get to do that in 4 weeks? Is it just frequent touch points during that diligence phase, or?
It is. It's pretty frequent. Typically, we might have an initial call or meeting. Week 1, maybe 2 to 3 sort of touch points or follow up calls or meetings in week 2, and then week 3 we'll go see them. And so it's accelerated, but again, it's just a rule we have. I know some investors are okay, not having the face to face, or maybe just doing a Skype video call or something like that. But for us, we actually have to go there. And to me, there's just there's things that you pick up on in person that you wouldn't otherwise. And so it's really accelerated. And we don't want to drag it out. We don't want to drag it out for the founders. We don't want to drag it out for us. We want to get to a relatively quick decision as long as we feel like we have all the data to make a decision. So we find like founders generally appreciate that. Sometimes, we just have to be sensitive to their time also. There's been a couple of times where we've realized that if we meet with them in person, especially if it's like twice, and we're still like, we think we need to meet with them maybe again, we're really not sure, that's generally that's not a fit.
Right.
Like when I mentioned before at Techstar, sort of not spending enough time with the founders. Sometimes it was, I had an initial 1 meeting with founders and like something just didn't seem right. Like there was this red flag, something maybe what they said didn't add up, the way they said and so without overanalyzing it too much, what I learned was don't ignore the red flags. However small you think they are, like if something just didn't quite seem right, it almost always is an indicator of something bigger. And so some of that is just trusting your gut and just not ignoring those red flags.
Yeah, one of my founders that does a little scouting for us, he calls it his spidey sense. It's going off for the wrong reasons, and he doesn't know why.
Exactly.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.